Last session, we began speaking about getting your finances in order and how that affects the saleability and value of your company. No matter who buys your company, an outside entity, your manager, or your business partner, there is going to be an investigation of the financials during the due diligence period. About half of all deals that enter due diligence do not come out alive. And the number one reason for the deal dying is usually financial cleanliness. Last time, we talked about two ways to increase the financial viability of your business: review your books and records, and reduce expenses to increase profitability. Today, we're going to cover the last of the top three: remove or limit non-essential and personal expenses in the business. If you have personal or non-essential expenses in your business, it is best to remove them. What are these expenses? They could be research and development costs, business organizations that don't generate revenue, or purely personal expenses like vehicles, healthcare, trips, and even uniforms. I get it. I'm an entrepreneur as well, and I know that by increasing our expenses, we can minimize our profitability and therefore the tax liability of our companies. However, most buyers of businesses are not entrepreneurs. Actually, the majority of them are people fleeing from corporate, chasing their dream to own a business. These corporate-minded individuals do not understand the tax game yet, that by reducing your earnings, you pay less in taxes. Other people that don't understand this game: bankers. So if you have too many personal expenses in your business, you'll not get paid the value you want from buyers, and bankers will not finance the deal, making seller financing much more significant. Now, there is a method where we can add these back or adjust them in a business valuation called adjusted EBITDA or SDE, but it causes messiness in the financials. I've seen clients with 10, 12, 15 add backs in their profit and loss statements. What this does is it causes the buyers and bankers to ask questions. To them, the add backs are red flags about the management of the business, even though it doesn't truly affect it. So after I explain this to clients, most of them say, well, I guess that just means I have to pay more in taxes leading up to a sale. Or just, but what do I do if I want clean books and records and I don't want to pay taxes? Is there a better way? And the answer is yes, there is. Many of our clients form a separate holding entity that provides management or consulting services to their operating company. And that management company is where the owners run through non-essential expenses, things like personal development or coaching programs like EO, personal vehicles or cell phones, and yes, even that strategy summit you held in Cabo. Then the management company charges the operating company a monthly service fee, resulting in only one add back to the P&L. So for this section, you have two choices for your action items. A, you can either clean up your business and eliminate all non-essential and personal expenses. Or B, you can speak with your accountant about creating a separate entity, that holding company, and move those expenses out of the company you are preparing for sale. Either way, this exercise is not as hard as it sounds and folds right into the previous lesson with your quarterly bookkeeping reviews. Get to work and then join me for our next lesson where we learn about absentee owner businesses.